Welcome to our series on the time value of money. Before we dive in, I want to spend a few minutes walking through what we'll cover in this series, so you have a clear picture of where we're headed and what you'll learn by the end. So time value of money is one of the foundational concepts in both finance and accounting. At its core, it's built on a very simple idea. A dollar received today is generally more valuable than that same dollar received at some point in the future. And while that might sound obvious, the mechanics behind it and the ways we apply it in the real world are extremely important to understand. So in the first few episodes, we'll build the foundation. We'll start with the intuition behind why a dollar today is worth more than a dollar tomorrow, and then move into the mechanics of how interest works. We'll cover simple interest, compound interest, and clear up the often confusing relationship between nominal interest rates and effective interest rates. From there, we'll work through present and future value calculations, first with a single lump sum and then with a series of cash flows. And as we work through those topics, we're going to take an approach that I think is really important. We're not going to start with formulas and ask you to memorize them. Instead, we'll build the intuition first and let the formulas come naturally from that understanding. By the time we arrive at a formula, you'll already know why it works, and that makes it much easier to apply in practice. Then once we have those foundational tools in place, we'll spend some time on annuities, which are simply a series of equal payments made at equal time intervals. These come up constantly in accounting and finance. Think about lease payments, loan payments, bond coupons. And we'll work through both ordinary annuities and annuities due. We'll also look at how to use Excel's built-in time value of money functions, and cover factor tables, which you'll almost certainly encounter if you sit for the CPA exam. From there, we'll add some complexity. We'll look at deferred annuities and examples where a single lump sum is combined with an annuity, including a practical bond pricing example. And then we'll move into uneven cash flows, which is where things start to look more like the real-world situations you'll encounter in corporate finance. And that brings us to what I think is the most exciting part of this series. After covering uneven cash flows, we'll take a deeper look at what interest rates actually represent, discuss capital allocation within an operating business, and then spend the rest of the series applying everything we've learned to a practical, real-world example. We're going to analyze a potential business acquisition through a full discounted cash flow analysis. So let me give you a quick preview of what we'll build. We're going to look at acquiring a fictional company called Evergreen Lawn Services. You can see here the discounted cash flow model we'll build over the course of several episodes. We'll start by modeling out 5 years of forecasted unlevered free cash flows for the business. Then we'll determine an appropriate discount rate by working through the weighted average cost of capital, which means we'll need to estimate both the cost of debt and the cost of equity. We'll calculate a terminal value for the business using a perpetuity growth model. And finally, we'll bring it all together to determine an enterprise value, bridge that to an equity value, and interpret what that means for our acquisition decision. And I want to emphasize, we're not just going to hand you a completed model and walk through the output. We'll build it from the ground up, stopping along the way to explain every concept as it comes up. By the end, you'll understand not just how to build a discounted cash flow model, but why each piece of it works the way it does. We've also included 2 bonus episodes. In the first, we'll build out a sensitivity analysis for our model. We'll use Excel's data table functionality to show how changes in our key assumptions like the discount rate and long-term growth rate affect our valuation. This is extremely common in practice and a very useful skill to have. And in the second bonus episode, we'll introduce net present value and internal rate of return, 2 fundamental metrics in capital budgeting. We'll show how those work at the project level, and then shift to an equity level return analysis where we look at how the financing of our acquisition affects the return to us as equity investors. This is where we'll see firsthand how leverage can amplify equity returns, and why understanding the relationship between risk and return is so important. So that's the roadmap. Whether you're an accounting student preparing for the CPA exam, working in corporate finance, or just looking to build a solid understanding of how money moves through time, this series is designed to take you from the foundational concepts all the way through to a practical, real-world application. So with that, let's get started. In the next episode, we'll begin with the most fundamental question in time value of money. Why is $1 today worth more than $1 tomorrow?